with the Let's get started. Here we are with the annual Rock Properties Investor Conference call. Thank you for joining us. We'll have more people view the recording afterwards, but it's great to have people live too. As is our tradition, I will talk for about 10 minutes and then we'll see if there's any questions. And we always get a couple of good ones. And my name is Andy Cohen, in case anybody's wondering, president of the company. So I want to start by talking about our site staff. These are the people who live at the properties and run them, the resident managers, the maintenance guys, the leasing people. And it became so apparent, especially with these last distributions where we broke records, again, they know excellence. They practice it every day on the job they do. And it's staggering to think about it. These buildings run 365 days a year, 7 days a week, 24 hours a day. They're an assembly line that cannot be turned off. And these people are there. This site staff is there day in and day out. It's amazing. I'll read one comment we got, and these are not, this is just the most recent one. We're sort of used to getting these. This came in about Angela, who runs some properties in Newark for us, and she also works in our office. She does double duty. And this woman wrote in, she works at Beth Israel Hospital, a tenant. I have to speak of all the selfless acts of my neighbor, Angela. She calls her neighbor, which goes to our mission of inspiring our neighbors. She goes above and beyond what the job requires. Several things she has done to help me and my son. One of them is coming over in the middle of the night when I was afraid of a not so pleasant situation, and Angela is right on the spot with support, even giving my son food. Having Angela as my neighbor, I feel completely supported and know I don't have to worry about anything. Going to our pledge of expect ataraxy. We are grateful to have her here. So we love getting letters like that. We read them for the whole staff. She wrote it in to us, and we love getting stuff like that. And the site staff is led by Ivan Bermudez and Jose Santiago. Ivan's been with us for 13 years. Jose Santiago grew up in one of our buildings. His mother is still a resident manager, and now Jose is a regional property manager. So so they've been with us a long time. And I would say in the last 6 months in the office, we struggled to keep up with the excellence the property managers, the site staff was setting. It was after COVID, we had a sort of a random reshuffling of staff. We lost our 3 core bookkeepers and May, our vice president. And I made a intentional decision to not hire quickly. I wanted to really dig into the bookkeeping to see what we could smooth over, what we could make more efficient. And we did. We upgraded a lot of the systems, but it was painful. And Angela and Julie and I basically struggled to keep everything afloat. And finally this year, after what we have is a lengthy hiring process, the mantra is to hire slowly. We brought on Merit Vickery, who's on the call, as our operations manager. She has set a wonderful tone for the company, really shown her leadership, and really getting us off in a great direction in the new year. And quickly we brought on Shannon McOsker after Merit, and Shannon has been the tenant and rent coordinator, and she's a dynamo. She's taken over that position. And then we hired Drew May 2 weeks ago from Bed Bath & Beyond. He was in their payables department. We got him, and he's really proving himself quickly. So so we're so thankful to have this staff. So I'll say 3 attributes that we always look for when we hire new staff, and these people, you can be sure, have them in force. One is an internal locus of control. You could Google that, locus of control, but you can be sure our staff has that. One of the first things we look for. The other one is empathy. And lastly, in a business like ours, integrity. There's a lot of money flowing through here, and we expect our staff to have integrity. And so just so you know, 3 things that these people I'm mentioning all have. You could say that people saw Rock Properties at its worst in 2023 over the 20 years we've been in business, because our K1s were 2 weeks late. We've never had that happen. And it's not something we want to do again. I know, especially disruptive for some of our investors who don't get other K1s. This is it. They're waiting for it. They notice. But it was a distraction for everybody, and it's not something we want to put people through again. I mean, the Oppenheimers have funds they have to the K1s flow up into. So it was a struggle, and not something we want to do again. And I don't foresee that happening again now we have the staff. Another thing we did actually is eliminate some of our third-party management. We take it on. It doesn't make us really any money, but it gives the staff more opportunity, gives the staff raises, but it proved to be a distraction during this restructuring we were doing, and we're eliminating and a focus on our core properties and growing them incrementally going forward. Something topic on everybody's mind probably is interest rates. You know, Fed raised them again this week. As far as our properties go, we really have almost no exposure. We refinanced 5 properties in the last year for rates between 3.6 and 4.5%. And those are locked in. 3 of them are locked in for 10 years. 2 of them are locked in for 7 years, so we won't be revisiting those for a long time. And we have 3 other properties locked in for between 3.5% and 4.6% until 2028. So those are set for a while. The only one that we have any exposure on is Associate 74. That's coming due within the next 18 months by the end of 2024. Right now, we pay $138,000 a year in mortgage interest and principal, and at 3.75%. That's a $2.5 million mortgage when we took it out, but we are paying it down. So we go to refinance, by the time we go to refinance, the new balance will be around 2.1 million. So it's going to be lower. We did a quick stress test. If the mortgages say are at 11%, and when Carl invested 20 years ago in Associates 45, our first property, and God bless the people who took a chance on a young real estater back then, like your dad did, Bill, it was 11% was our first mortgage. So if we go back to those days of an 11% mortgage, that would eat up about that would increase the annual mortgage payments by $100,000. But we've been averaging around $200,000 in distributions. So it would be a material impact to distributions. It would cut them in half if we got to those days, but the property would still clearly be in the black. A couple of more items, and then we could wrap up. We finalized the sale this year, well, the end of last year, of 181,559, Associates 181,559. That had sold its 2 main buildings 2 years ago, and we just sold the last 2 houses last year to a neighboring investment, Associates 64. And so that ends the Associates 181,559 run. We filed the final tax return. That's the last K1 those investors will get. They got a nice windfall when we sold the 2 houses, but we still have almost $100,000 in reserves to pay accounting fees and any unforeseen expenses that come up. And in a couple of years, we'll distribute that money out. And so those investors will get just another windfall of a few $1,000s, probably about 2 years from now, but no more K1s. We finalized that. And Associate 64 next door that bought the houses had its highest distribution of all time, actually. So it worked out. I think I might say it worked out on both sides. The last thing I want to mention is amendments to the first 2 investments that we have. These were set up as general partnerships early on. Everything else is an LLC. So we're sending out amendments to conform their language and their succession plan. If something happens to me, if I die, we worked a long time on the LLCs, and now it's been about a year in the making, we're bringing the general partnerships into align with what we did on the LLCs. It's no new language in these in these amendments. It's things we've been signing for years in the later amendments, but we wanted to bring them up to date. I will, and also in the amendments to bring the partnership agreements in line with the later agreements gives the manager the right to strategically acquire neighboring properties if they come on the market. We've had great luck with that. We've bought 6 houses that neighbor our properties. They've added a ton of value, and we want to continue to be able to do that. And these 2 properties, these 2 first partnerships did not have that language. So it gives us that language, which accommodates Associate 64 buying the 2 houses next door. Yeah, they'll align with that. And that's it. So that wraps up our succession planning. Once we get those 2 amendments done, it puts us in good shape. We want to really be sure that if I die or become incapacitated, there's no hiccup from day 1. Right away, we need to make sure everything runs smoothly. And it's set up now so the investors will hold the vote to decide whether to sell off the properties or continuing as we've done going forward. But that vote would take 90 days. We need somebody running the investments for those 90 days. And even if we decide to liquidate, if the investors, not we, I won't be around, but if the investors decide to sell off all the properties, that takes at least a year. You can imagine you have to hire brokers, sell them, and then file final tax returns and final distributions. So we need somebody in place for that whole time, and this allows for that. That's all I have. If anybody has questions, love to welcome them and answer them. I see some familiar faces here. Anybody, please, Ian, you raise your hand.
Yeah. Hey, good morning, good afternoon. So
Yeah.
I know that you're keeping tabs of what's going on in the marketplace. So my question to you is, I probably ask this during every investor's call is, are you looking at anything? Are there opportunities that you see in the horizon based on what's happening with the market conditions today? Are you staying on the sideline at the moment?
Yeah, I mean, we don't compete against the speculators, so it's made it very difficult. We're really such a quaint boutique investment, real estate investment firm. It's almost ridiculous, but yeah, we can't compete with speculators. There is some softness. I see it in other sectors, in office with really much higher returns. You can buy in for higher returns, and retail. I haven't seen it really yet in residential. The sellers are still holding out for old prices they thought they were getting, and buyers haven't stepped up. Mortgage rates are not as crazy. I don't know, Ian's in banking, I don't know if you're seeing it, but the multifamily guys are telling you mortgage rates now, you could probably get them in mid fives. That was before the Fed increase, that was a couple weeks ago, but so it's not horrible. So yeah, but I haven't seen, there's no blood in the streets. You know, that's going to be a very narrow window when we get an opportunity to really jump in and start buying a lot of property. It's not there yet.
Well, I think,
Yeah.
Bill. Oh,
Andy,
anything else, Ian? Oh, hang on,
Nope.
hang on, Bill. Okay, good. Thanks. Thank you.
What prospects do you have? Doesn't sound like you sell very often or at all. It sounds like you buy, maintain a portfolio, and create a cash flow and manage these properties. That's kind of what you do.
Yeah.
So are there times when you, like I heard you just sold something, but as far as some of the other properties, are there any plans to ever sell, or what's your scenario?
It's a good question. We have sold off 3 or 4, one we exchanged into another property, but we have sold usually the smaller ones where we feel like we just maximized any upside. We've done everything we can. We've reconfigured, we've redone apartments, we've redone the grounds, we've redone the lobbies, and we don't see anything else we could do. And actually 3 of them that we sold, the buyers ended up in bankruptcy. So it was worked out for us. But listen, rents, the increases are mind-boggling in what renters have been faced with in terms of, you know, increasing rents on apartments, and they're still going to be going up. And we have a lot of upside in the rents. Our major expenses are stable. So as long as we see that, and we're getting these kind of, you know, upper teen returns and mid 20% returns, we have no desire to sell, really. So we don't want to pay the taxes. We don't have to redeploy the cash into new expenses. So we'll just keep enjoying steadily increasing returns into the future.
How many properties you guys own now?
We have 13 partnerships. Yeah, each one could have multiple properties, but 13 partnerships going right now. Yeah. Anybody else?
Hey, Andy, I just wanted to
Carl.
Say, hey, first of all, it sounds like you're still doing a great job on the, you know, the staff and the people on the ground, having visited the properties and seen it firsthand. It's, you know, I've known that's always been there, but great to hear that that culture is still, you know, strong. And I'm glad that things are going well at the office, and you've hired some new people. That's great.
Merritt wave. Everybody say hi to Merritt. She's on the call. That's Merritt. That's my name on the call.
Merritt,
there you go.
spoke yesterday.
Yeah, you spoke yesterday, right?
And then I guess my only question is on the changes to the documents. You alluded to it as far as this succession planning issue, but I didn't hear it. Is that the reason that we're signing these is so that we can pay an additional fee? Is that right?
No.
Okay. So that's wrong. So there is not going to be that additional fee?
No, that's already in the documents. We don't need a member for that. That's been there.
I thought there was not in the 45 documents.
I think it's there.
Okay.
I have to check that. Yeah, I have to check. Maybe
yeah, because I thought that that's why we were signing the documents from our previous conversations on this. And I'm sure this is all public, right? This is a public forum. This is what.
Yeah.
Okay, good. So what you're anticipating is that you're going to be adding another layer of management fee a small one to begin, but this is presumably, as you're saying, for succession
Exactly.
planning,
Yes.
but we're adding it now.
We're taking it. I mean, this is an issue that's near and dear to Carl's heart. We have had a number of discussions about this, and it's. I will try and summarize it. Here was a 4-page memo to Carl. The properties language fails us here a little bit because the properties have managers, but 2 different kinds of managers. They have a property manager who's paid to manage the property on a day-to-day basis for a percentage of a fee. And that's Rock Properties, and we have a staff to do that, and we're hired by the companies to manage the properties. There's also a company manager. The company manager represents the owner's interest. Could be the landlord, it could be the owner, it could be the investors, but there's the owner's rep, but there's got to be somebody on the company side to represent all the LLCs. And they have 2 not necessarily aligned roles, right? The company manager oversees budgets. You know, what's the final budget? Property manager can prepare them, but somebody's got to sign them off. Company manager signs a tax return. Company manager decides what the distributions will be. Company manager decides really capital budgets, how much rent, what kind of rent increases we should be putting in place, signs off on the insurance. There's a lot of higher level things a company manager, company rep, it's the representative of the investors has to do. And the maybe I got to look, thanks for mentioning, I got to look back. I think 45 is a little conflicted, but I think in the end, it does give us the language. But all the operating agreements, it's boilerplate. The lawyers put it in there. We didn't ask for it. It says that the company manager can charge the costs and fees for being the owner's rep and running the companies. Completely different than property management. The property managers run it on a day-to-day basis. So it's in there. We never took it. I never took it as the company manager, and now it's an LLC. We never charged a fee for running the companies. But now, as we're planning for succession, it became apparent that the new company manager will not have any equity in the properties. That goes into my estate, divides up to my kids, however I want, my partners do. But we need somebody to run the companies, and they're not necessarily the person who has the is the heir to the estate. So they're going to have to get paid, and maybe even up to $100,000. I mean, pick a number to run 13 investments and take, fiduciary responsibility for these on a month-to-month, not day-to-day, but month-to-month basis, making sure everything goes smoothly, and coordinating a vote of the limited partners, whether to proceed or to sell off after I die, and then hiring the broker, doing that whole process. That's you're gonna have a real hired hand in there to do a good job. So as part of that, I said, okay, we're gonna have to pay him later. I'm gonna make just to show it on the books and prove it. We're gonna start paying that fee. We didn't do it for 28 years. I guess some people would penalize us for that, but most people I talked to said gave us thanks for the free ride for 20 years. So now we're putting on a 0.1% of collections fee, which is going to be around $10,000. We'll take it for last, it's retroactive to last. We'll take it now for last year, but we haven't taken it yet. So we distributed about 2 million, I think, each of the last 2 years. So 3.5 and everything else. So we'll be taking about we will be taking about $10,000 to cover all those things we do to manage the LLCs on behalf of the investors. And then that'll be on the books. There'll be a line item on the chart of accounts. And then the next manager will see that, and we'll slot in whatever the investors have to decide on how much that person should get. But it's going to be real money at that point when there's a succession manager. But this is really, I think it was really, I felt it was prudent and the smart thing to do, not to put $10,000 into Rock Properties or my pocket, but to show that, maybe to flesh out a conversation like this, to show that a succession manager will come in and will get paid. And it's already on the books to do so. Any other questions? Go ahead, Don.
Thanks.
I like your background. Go with those frames. I like that.
Thank you. First question is, how are you feeling?
Never better. Yeah, never better. You know what it was? A guy dropped one of my friendly competitors in town here in Newark. We had lunch. Everyone thought he died of cancer, and it was chaos. He did not plan that well. So we've been spending the last 2 years since then. I don't want to, do it while you're healthy. Everybody.
That's good news. So as a major investor, and obviously I only have one interest in 64. What is this going to do to me personally? Is it a a large cup of coffee at Starbucks that it's going to end up costing me as a result of going from a partnership to an LLC?
Oh, no, they're staying as, the first two are staying as partnerships, general partnerships.
Yeah.
We're just conforming the language to the LLCs. We would love to convert them to LLCs, but we're told that would actually trigger a paper sale and we'd have to pay the, pay the capital gains. So even a conversion like that. So no, as far as you go, it would be a large cup of coffee at Starbucks. Yeah.
So again, relative to 64, what happened when it made the acquisition of another rock property? Who does the appraisal? How do I know that I didn't give the partners of 181 more than they were truly entitled to? And in that regard, what kind of expenses or fees? Was there a brokerage fee or anything like that paid to, internally, or did it go outside to a third party? How did that work?
Okay, yeah. You're asking a couple of things. One is getting to the integrity of the deal because
Right.
it's not arm's length. And we hired a third-party appraiser, the one who did the bank appraisal 2 years before. We didn't pick anybody special, and appraisal went up actually from it. By the time we did the deal from 2 years ago, when we sold the first 2 buildings because houses were going up, and we just went with his number and they paid it. The Associate 64 paid whatever the appraiser told us. There's nothing on our part we did. That's the first thing. And the second thing is, yes, rock properties, as the partnership agreements allow, we are entitled to to share. We're brokers and we're entitled to share in the broker's commission. We can't take higher commission than we would get in the market, but if we ever sell, we can talk to the broker and say, listen, would you share some of your commission with us? And if they're willing to do it, we are entitled to get paid on the sale. And this was a sale, and we did take $28,000 of the 1.4 million sale price. I think 2%. It was a novel transaction. We'd never done anything like this before. We had originally contemplated a merger back and forth with lawyers. We decided that wasn't feasible, so we did it as a straight sale, and it was quite an undertaking actually to do it and get it right. So we took a fee, $28,000.
Okay.
Hey Mel, how you doing? See you down there. Good to see you. All right.
Question for you.
Oh, good.
I came in late, so I didn't hear what you had to say earlier, but I'm just wondering whether in the next year or two, you have any financing that reaches its end and that you then have to refinance.
Right. Well, we have come full circle. We have no interest rate exposure for the next 6 to 9 years, basically, and they're all locked in at 4.6 or less, except for one property, Associate 74, and we have 18 months to sort that one out. But even if rates go to 11%, it would be well in the black. It would materially impact our distributions, but the property would stay well in the black. So
Well,
we're pretty.
Terrific job.
Oh, thanks. Thanks so much.
I'm involved in a number of these things in various areas, and this one probably is the most straightforward, and it certainly performed extremely well. Congratulations.
Thanks. Thanks so much, Mel. Appreciate that. Really appreciate the kind words. Yeah. Any of them still waiting? Are you still waiting on K1s from any of them? Or they've all gotten to you?
Are you talking to me?
Yeah. I know you have a lot of investments out
I
there.
have to hear from my accountants. I have no idea.
All right. So probably still waiting. Right. Okay. So at least we're not the worst of the worst.
No,
This
no,
year.
no. We're talking about that. I have K1s that will not come in until September, I'm sure.
Okay. All right. There you go.
Andy, I got one more question.
Sure, Don.
What does it take to have a building named after you?
We're proud of it because you can't buy it. There's people who aren't even investors, and we'll put you on the list. We'd love to have the Don Stopler building. Yeah, we do have the Phil Oppenheimer building, that's for sure. Yeah, good question. All right, if that's it, we're 20. I guess we're 27 minutes in, 26 minutes in, which is our limit actually from traditionally. So thank you everybody for joining us. Come back on the recording and have a great day. Thank you,
Great
everybody.
job, Andy.
Thank
We
you.
Laufers appreciate your efforts. Thank you so much.
Thank you. Thanks so much, Bill. Been with us forever. So thank you. Thanks so much.
Everybody. Take care.
Take care,
Bye-bye.
everybody. Good. Bye-bye.